Welcome, morning. It is smarthelping.com. I've got an update here on the preferred equity model. One of my favorite pieces of logic here. And the update is mainly I added a key for the input cells up here to make it super clear what's going on. And then I added one piece of logic to zero out um, an error that was being thrown if the basically if the investor LP was 0% on the common equity side of it. So let's talk about this real quick. What the model does at a high level, you put in the total project level contributions and distributions, whatever they might be. You'll probably have other models to figure that out. This model is just to figure out how the cash is going to be split once you determine, how much was put in by equity and how much is returned to equity. Um, so in this scenario, let's just make it a real even number. Let's just say $10 million was the required investment. Oh, minus 10. And 60% of that came from preferred equity. So the preferred equity leg invested $6 million. And so what this model does, it's a hard preferred equity model. And by hard, it means the full 100% of the preferred equity contribution is repaid before any cash goes to anywhere else. So this is like kind of like the senior equity, and then you have got subordinate equity, which is a common equity that gets paid out after the preferred equity is fulfilled. Now we've got some nice logic here for how the preferred equity is repaid as far as they do get a pref return here, as well as potentially a kicker on any remaining cash flow after they've been fully satisfied. So in this preferred return can actually the shortfall can be added if there wasn't enough in a given year and it'll roll over. Also, you could have it to start clean each year. So some nice logic there. And what the model does is shows you the pref return each year based on what was contributed versus what was returned, what was available to be returned, and then the remaining cash um, would then be split between the preferred equity part and the common equity part based on this percentage here, 15%. So in this case, it's 15%. Um, so let's say you had, let's make this a bigger number. Let's say this is, okay, so just so we can see the logic. So you can see here the pref return. This is just returning all of the money back plus giving the yearly pref return percentage. Then you've got the kicker here. So you can see in this case the kicker is 15%. So in year five, if the preferred equity has been fully satisfied, 200,000 is split then 85/15, and that would be 30,170 for the 170 for the common equity. Now here's where it got complicated because I wanted to make the model even more just have even a more wide use case. So I did logic so that the common equity could actually be a either a general partner or a general partner and a subordinate limited partner, meaning that okay, you've got your pref equity here, you've got your secondary investors here, and then you've got your the general partner with the rest. So before, if the common equity investor was at 0%, it was throwing an error in this waterfall for one of these distribution rows and just causing it to basically you would have to manually go in here and make the LP 0 in each of the hurdles and 100% here, and then on your final summary, it would say the common equity investor was getting all of the return, and then this sponsor would have an error, which is not desirable, so that's now updated, so it doesn't do that, and you can have a 0% for LP, like basically subordinate investor, and it still works fine. Um, and you can see all that really matters is, okay, here's your pref cash flow, here's the common equity cash flow. And the common equity cash flow then can potentially, if you want, let's say there was a percentage here, let's say 60% came from the pref equity. Let's say you got 40% left. Let's say 25 came from the limited investors, and the remaining 15 came from common sponsor, general partner, or general partner. So now you have a situation where, okay, you know what the pref equity is getting in their kicker. The remaining cash flow is then split yet another time between these two in more of a IRR hurdle situation, um, like this, where you've got hurdles and the investor in this case is still, willing to give up some of their share. Um, and in this case, they're starting at 60, so this would be somewhere number below 60 and down, but these are editable, depend on what this final percentage breakdown is between the subordinate common equity, LP and GP. But then this goes through all this logic so you can actually see it's possible to have basically three legs instead of two. Now, if you just have pref equity and then the GP and you don't have a secondary LP, you just put 0% here, no problem. And then it flows all right through. This common equity, essentially, none of this logic is being utilized. It's just flowing all the way through the total cash to the GP, and then it comes through here for your internal rate of return, and then running cash position summary as well as a visual. So I just basically what I try to explain to you, I just put it in this key here for each cell F3, F4, F5, F6, and then put a note about what this means because I've had a few people get a bit confused on this, and it's just now the way it's set up, it's perfect. It will be less confusing, super clear, and it it runs all the way through to the final summary no matter, obviously cell F3 and 5 and 6 will always have to add up to 100%. There's no situation in which they shouldn't. It just depends on where the remaining cash flow comes from after the pref equity. Note that if the preferred equity, if it's 100%, meaning that nobody gave any cash contribution except for this preferred equity leg, that's completely fine. What would happen is then um, they get their pref return, and then they get a kicker on any remaining cash flow, and then it's just there's going to be no internal rate of return. There's equity multiple still, but there's no um, or no, there's just equity multiple and internal rate of return for the pref. The other since the other no other equity was contributed, these would just be NA, which is completely normal, and then this is the cash distributions. So this should work basically in a vast majority of cases. All you have to do is plug in the contributions distributions here, and away the logic goes. And now this is a bit more clear what's happening with these percentages. So we'll put this back to, let's just say this is 60, and we'll just leave that at 0 and 40 for the, actually let's do 80 just for the base default numbers. But whatever your numbers are, you can put them in here. You could adjust these up here. And yeah, I love this logic. I love the simplicity of the model. Where it's very clear what's going on. Here's the money available, and then here's all the logic for how it's split, and then here's the final summary of that cash split. I've never seen anybody try to do a pref equity senior and subordinate version with the common equity, where you have two more legs down here potentially. But if you only have one leg at the top for the pref and then one for the GP and then no secondary investor, that's completely fine too. You just zero it out, and now it flows all the way through. All right, so that's the preferred equity update. If you already bought this model, you can just email me. I'll send you the latest version if you want this version. Also, if you want to check out smarthelping.com, some new things I've done. Number one, I do Twitch streams live every Tuesday morning at 9 a.m. It gives anybody the ability to come and talk to me about anything during that time, and I'll also be building things ongoing. Like right now, I'm working on the salesman tracker for like a car salesperson and like a pipeline for them to manage their potential customers. And um, then I've got a live chat here as well now. And then you can also check out the financial models. I've got all kinds here. The joint venture ones are at the top, which is what I just went over this one, the very first one. But you've got joint venture models, you've got all kinds of SaaS models, um, accounting tools, real estate, help organizational tools, just general sales pipeline stuff, KPI trackers, and then industry specific models, which the main thing with these is what's different on each of them is how the revenue is generated, and then sometimes how the variable costs are generated if it's specific to a given type of business. General business models, valuation, data analysis, and some other ones. Now, the other thing I do want to point out and make clear is that all these financial models, like the industry-based ones that are just usually 5 or 10 year models, they don't have a specific balance sheet, income statement, cash flow statement. They get down to EBITDA. They also, some of them show taxes in net profit or net cash flow after that. But if you want formal financial statements, it's too cumbersome to build each individual one out for these. But I just did a generic template right here, which has the ability for you to input data from a model, and it'll produce monthly and annual income statement, balance sheet, and cash flow statement. And it handles pretty complex things, so it's fairly robust. It should work in most cases. Um, Alrighty, well that's all I got for you. I'll see you tomorrow on the Twitch stream. We're gonna do a car salesman pipeline tracker. Try and get further on that, and we'll keep on going here.